I spent 30 years on the other side of the curtain. And let me show you how we, on our proprietary desk, made decisions with millions of dollars on the line. You want to trade breakouts? You think they're clean? They're not. There's a lot going on behind the scenes. You think price moves randomly? At times, in the shorter term time frames, like the 3-minute chart or 1-minute chart, there is a lot of random movements. But really, in the overall marketscape, it doesn't move randomly. There's a system behind every major move built on two things: corporate orders and overall liquidity of the market. I'm going to break down some things for you to try to get you a clear understanding. Welcome back, everyone. It's Tom from Park Avenue Trading, your chief dealer, keeping you sane in these insane markets. If you like what you see, smash the like button, hit subscribe, share the videos far and wide. I want to build a big trading community, an educated community with my 30 plus years of experience behind me, warts and all. So hang tight. Let's get right into it. Back when I ran institutional FX desks in New York, our job was simple: move size when we had to, manage the risk of the size, and protect our main corporate interests. But also, we had a little twist on that. We would abuse those corporate profits. But the edge really came from knowing exactly where our corporate orders were. Retail, a lot of people on YouTube profess like retail traders. Banks don't give a shit about us. They don't even know we exist. Okay, we're just like little gnats that, don't even annoy them. They're just doing their business. They got millions of dollars. Just for an example, $1 million was thought of as a very, very small trade. Very small. Matter of fact, our brokers would say, I need a price in $1. That's $1 million. Generally, that trading occurred in the spot Forex market. It was really size started at $5 million. Okay, so up. So generally, all the price quotes would be from $5 million and up. If you needed a price on a larger size, you would go direct on your Reuters dealing system, and you would go to a bank of your choice. Maybe Citibank or Morgan Bank at the time, Morgan Guarantee Trust, which is now just J.P. Morgan. But you dial them up on the Reuters dealing terminal, and you'd say, I need a price in 25 million, 50 million, 100 million, and they would make you the price on it, and then you would deal directly with them. However, the brokers, it's very similar to what you're seeing in your retail brokerage, is really designed for small size. As a matter of fact, the maximum size that I trade is 25 lots, and I'm trading 25 lots when I'm making money, and I use a system, a money management system that is called the fixed delta system. If you don't know what that is, you could, look it up. It's a way of actually determining when you can go larger, and I work up to 25 lots. Risk control is the most important thing for myself as a retail trader now, just as it was in the bank. But like I said earlier, knowledge came from knowing exactly where the corporate orders were. And they generally are and still are, above highs, below lows. And, a lot of people talk about round numbers. I believe there's only a certain really fixed set of round numbers. That a round number doesn't happen at the figure or 30 or 50. I think that it goes a little bit deeper than that, but a lot of people talk about it. So I'll say, okay, around round numbers, and using liquidity around those numbers to fill some positions. So we're going to get to the myth of clean breakouts. All right. A lot of people, just jump into and chase a breakout. Like, they're waiting for a market to break a top. However, there are certain things that have to occur by a top, or conversely, at a bottom. There are certain things that have to happen at a bottom. And I'm going to go over a couple of those things. And also, I just want to point out, go to parkavenuetrading.com. The link is in the description. And you can get yourself a free ebook that goes deeply into like how to avoid false breaks. Like, put some probabilities on your side. It's a great little book. It's totally different than what's out there, and I suggest that you do it. After all, it's free. You know, you can get the book and then just unsubscribe from the email list, you know, if that's what you're into. So anyway, retail traders often chase breakouts, and they're not putting the best rules in place. And I'm going to go over those rules. So I don't just buy a breakout. I really look to see what happens at a breakout. Now, a lot of people talk about liquidity sweeps, and then, you know, I don't understand the new terms for it. I just know resistance and support. So if I'm up against resistance, I want to see a couple of things happen, and I'm going to take you through that. I and myself, I'm not with them anymore, but, you know, I just don't blindly, you know, short a support point. You know, I don't blindly buy a resistance point. I want to put some probability on my side, and we're going to take you through that in this video. So starting right now, let's talk about one of the things we need to look for. So the first thing that we have to look at is market structure. Now, if you don't understand market structure, you should get a book on it, or you should go look it up on YouTube, and I actually have some videos about market structure. So really simply, what market structure is saying is that if a marketplace is in an upward movement, what is it going to have? Well, it's going to have higher highs and higher lows. But there are some, and if it's in a downward movement, it's going to have lower highs and deeper lows. Now, you could look at market structure on, like, this is a 6-hour chart. You could look at it there. If you're trading 6 hours, if you're trading 1 hour, you can do it there. If you're trading 10-minute chart, you can do it there. Everything's relative to what the chart time frame is. All right. So looking at this 6-hour chart, okay, if I was just to come back in the past, I could look and see that there was a peak point at 176.48, right? So I can take a line and I can go, okay, that's been my high. And then the marketplace actually did a nice retrace, okay? But really, if I go back in time, I'm going to look at the origin of the upward movement. I'm going to start from there. I'm going to throw a line right there, okay? So really, this marketplace is in an upward movement right now, okay? And I'm going to show you where the breakout was. The breakout was right here, okay? I'm going to show you the breakout right there. The breakout was right there. Now, I'm doing this as I see the chart. I didn't set this up. I don't ever do that. I just go, all right, let me put my theories to the test, and let me get a chart that I really don't know. And I really don't trade Swiss yen often. Actually, you should start to look at it. It's becoming quite volatile lately, so it might be a good little cross currency to add to my repertoire. But when the marketplace did two things, okay, all right, after this breakout, okay, if you notice, the first breakout came and it kind of failed. It would have freaked people out. If they bought the breakout, they probably would have got out at like near the lows or so, thinking that we were coming back into the range. Now, the first indication that the breakout was good is when we get this. There's two ways of looking at it. When we get two consecutive highs in a row, that would potentially say that the breakout is good. So if I'm looking at this chart, let me get a circle here and let me show you what I'm looking at. It's also easy to do when the market's dead, right? But really, if you follow these rules, it's going to help you tremendously. So right here, I want to point out these two bars, two consecutive highs in a row. Now, that is like the liberal way of looking at a market. There's a conservative way as well. You'd want two consecutive up closes in a row to say that the marketplace is in a good breakout. So if I'm looking in this area right here, I get two consecutive up closes here. That would get me in the breakout a lot later than if I just look for two consecutive up bars. Now, what does that mean? It means that it doesn't mean it can't retrace. It can retrace. As you can see, the marketplace gave two consecutive higher bars, like right here and right here. It kind of peaked out again at this top. and then came down, and guess what it touched? It touched the old top right here. That top is now acting as support. So that's giving you a good indication that the breakout is good. Now, how you would handle it. When you get to 2 up bars in the row, you'd have to actually be a little bit patient, because this is a 6-hour chart. If you look at this, this is 1, 2, 3, 4, 5 6-hour bars. 5 6-hour bars, 30 hours of consolidation. This is where most retail, or most, like, even if I didn't have bank experience, where I would lose patience. I'd say, this thing's going nowhere. I'm just not even going to pay attention to it anymore. So the market lulled you to sleep at this point. However, this was the place to buy it, right there. Oh yeah, Tom, great. Yeah, you see it now. Look at the breakout. No, I mean, I would see these two. I'd go, all right, I could place a standing order to buy, maybe down by this low right here, or even potentially this low at 170, 168. And let's say I was really aggressive and I bought, this low right there, 170, 189. I knew that if it broke this top, this old top, that the trade would kind of be a little bit in trouble, all right? Or there'd be something wrong. Now, what would I need to see for me to say, oh, this shit's not right? Well, I would need to see basically, let me see if I can get my brush here. I would need to see a push down a low, and then another consecutive low. That's not exactly the best arrow. I fixed the arrow. So then we would need another consecutive low. Again, another crappy arrow, but anyway, you get the point. So I would need 2 consecutive lows in a row saying, oh, shoot, this breakout was false. Now, of course, 6-hour chart, if that was to happen, it would be a deep retracement, and that wouldn't be the greatest thing. So there's the first kind of setup. Now, the second one, and it's one that I go over in the free ebook, the 3-step book itself, is before the breakout. All right, before this breakout, I would have liked to see a down close on that bar. So in other words, if I erase these 2 bars and I'm looking at this bar right here, that's what I'd want to see before the marketplace took this bar up. That would give me a better idea that the breakout is real. Why? Well, if you're thinking about a down bar or a red candle, what happened is that the bears won the battle on that bar. So they pushed the price down. There's more proclivity for them to actually buy a breakout, to get out of their short, if on the next 6-hour bar, 1-hour bar, 10-minute bar, there's a chance that they're going to escape and they're going to push the marketplace up. How much higher, we don't exactly know. However, we could basically take an idea of that, and I'll do that in another video, because we could actually measure the distance between this high and this low and project that distance up for a decent idea of where the breakout should stop. So that's one way of doing it. So if you want to look, what people call liquidity zones, all right, they're above recent highs and they're below major lows. Now, if you want to look at psychological levels, well, if you want to say 172 even is a psychological level, 173 is a psychological level, 174 is a psychological, fine. Do your own research on that. I don't think that round numbers actually, are every big figure. I think they're somewhat a little bit different. And I teach this in my personal mentoring. So it gives me a wider view of what I would consider to be, a round number. And what my idea was actually developed by my treasurer, Aldo Pizzaferrato, who was trading a lot longer than me at the time that he taught me that idea. So anyway, so we know that, most people would say liquidity zones are down by the lows. So how can we deal with a liquidity zone that's down by the low? Well, we could look for a breakout bar, you know, and I explain that in my course, Tower of Price. I like to look for a breakout bar. And what it simply is a breakout bar is one that basically takes out this structure right here, this whole structure. Okay, so a breakout bar is one bar that is this. You see this bar? It took out this top slightly, but it broke away from the bottom. So now I can say that this level down here is a good support point. So with a breakout bar, you know, you can get long. You could use a Fibonacci level to get long. You can, you know, you could just buy it straight out and put stop below the low. But I would suggest that you use something, you know, a little bit more scientific than just buying it. All right. So what I'm saying of this level here is you just don't buy the breakout. You're looking for the confirmation of two higher highs in a row. That gave you the idea. And then you look for the retrace. You look for the retrace coming back down to this level. You know, you don't quite get it on this bar, but you buy, you know, in this area right here. You'd be looking to buy in this area right here, like right in this area. Wow, that's a big mess. All right, so that I think explains, like you wait for the reaction to the breakout. You also look for the two upward closes, or if you're looking more conservative, you want two higher closes in a row, which equal this. Now, the marketplace, let me get out of this. Marketplace came back up, makes a new high right here. So you know that people went short right here. Well, that liquidity zone or the stops are going to be above this, okay? You have support down here, all right? So now you'd have to pick your point of where you'd want to get involved in this. And you could use a fib level if if you're saying, well, this is upward movement, and then we could potentially be going into an upward moving market still with a downward moving slope. So that's what this is right now. It's an upward moving market, downward slope, okay? It would only change directions if we broke this and then created two consecutive lower lows. Then we'd say, oh, we've changed from uptrend to a downward swing. Okay, a major breakout would be below this point right there, but we don't have that to worry about right now as the marketplace actually started to recover. So, how you can handle this, all right, and is you could actually do a couple of things with it. I don't know why it doesn't want to remove. I don't understand this thing. I've been using it for 12 years and I still get it wrong. I am now resigned to getting this right. So you can measure the leg. You could use a Fibonacci. You could get involved with a fib. You could do same type of thing here. You got the low that was created. You got two consecutive higher closes, and you got two consecutive upward movements. That's basically saying that this bottom should be good. You can get involved on the retrace. So you got these two signals right there, just as I pointed out. And then look at this. As the market comes up, it comes very close to this top. Another retrace again. It's still upward, upward, downward swing. Now, let's see if it breaks out of this top. I'm hoping it does so I can try to prove it. I don't know. Let's see. Come on, Swiss yen. Very, very close to the resistance again. Look, only one punch up. There's no two consecutive in a row. It's actually saying that this top is holding for right now. And now look at this. We get a retrace. Bang, bang. Two consecutive up bars, two consecutive higher closes, saying that this is potentially a very good breakout. It goes up, let's see, from bang, bang, from 177, it went up to 178.04, 104 points, still in an upward movement. Again, retrace closer to the support, same gig, and then we get the breakout again higher here. You could do the same thing over, all right? So what I just told you was, one, have a rule for breakouts. Two consecutive up closes on an upward breakout, two consecutive lower lows on a downward breakout. Also, just let me reiterate, the liberal way of doing it is 2 consecutive highs over the breakout like this, 2 consecutive highs over. However, we also have in this like a double confirmation, 2 consecutive higher closes, showing that the market is gravitating towards going up. Look, it's not without, without a battle. As you can see, as we moved up, if you would have got long, say 177, right? Well, you had a chance to get out 177.80. That's not a bad trading day, right? If you were a longer term trader and let's say you held, right? It's like 178.21. Don't get, upset if we have the breakdown, as long as it doesn't break this. If you got to decide whether or not you are a long-term trader or you're a short-term trader. Don't take a small picture trade and turn it into a big picture trade. Just follow the rules. Okay. Now I have some notes here I want to look at. All right. So what do we want to tell them? Yeah. Well, I think that's about it. I think I covered it up, covered it all, what I want to say, a lower high after a stop run. All right. Yeah. Okay. So let's see if I can find it. Since this was a really straight bull market, let's go back in time right here. We had this high here. Here was the resistance point. We had this high here. We had a lower high here. You could look to short the bottom of this structure. Okay. Let me look for one on the other. Okay, so we didn't really have a stop run that was below here, but the idea is we got the low, we got the 2 upward pushes, right? As we have the retrace, you could look to buy in this area here. So you would buy as the market came down here, and you have the 2 confirmations. We got bang, bang, up. And look, we still get a retrace. So the market gives you plenty of opportunity to get involved. So that, I think, will help you. Please, it's not anything. Just go over to Park Avenue Trading, get yourself the free ebook, sign up. I send out some really cool emails. They're not really salesy. They're basically telling stories so you get to know me. And I look forward to seeing you, in the next video. Remember, stop trading breakouts blind. Okay, don't trade them blind. Employ some of these rules. Go back and test what I'm talking about so you can actually see it in action. Okay, it's not going to work all the time. Absolutely not. It just won't. And on this chart, it was amazing that it worked out perfectly. And I didn't expect it to work out perfectly. I actually like when it fails, so I could say, you see that one failed, because we're talking about probabilities, all right? We have no control over the outcome. We just have control over how we handle ourselves in the market. So I look forward to seeing you in the next video. And remember, always, 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 as a short-term trader, enjoy the party, but dance near the door. Cheers.